Okay, good morning, everyone. Happy Friday. Looks like we've got a few people jumping on. Welcome to the virtual coffee workshop. Um, Hopefully, sound and image is working okay. Just got a late starter here. Just bear with me 1 second. Um, Here's my coffee from my local favorite, Skinny Cap. I got a large one today, so if I'm bouncing off the walls in a few minutes, you'll know why, but I better pace myself. So without further ado, let's get started. Um, I'm going to bring the agenda up. Rough plan today is to spend about half an hour talking through a couple of main areas. Let me just check the messaging. If anybody has any issues, just message me. I'll just check that before I get started on the chat. I think we're okay. Bear with me 1 second. Let's have a look. No, all clear. Okay. All right, let me show you the some slides. So, agenda today, we're going to go through the latest investment results and look at the main asset classes, bit of commentary on what's been happening and why, followed by a great article I read in Money Magazine about possible ways to save in some of the main areas of everyday costs. In particular, the three that I liked in the article were power bills, groceries, and health insurance, all everyday expenses for us, no matter what our age and stage is. And then also a late starter, but again, a really relevant topic at the moment is anything to do with digital security and something I wasn't aware of around QR code scams. So we're going to look at that as well as some ideas that you can take to protect yourself. And then a couple of questions. Happy to field those at the end of the presentation. So let's have a look at investment markets. And the way we start with that is we have a quick review of the quarterly report from our head office research and investment team, which is the Q1 March quarter review. Again, you can read this in your own time. So really today is just about very high level overview and sort of pertinent points, some of which I mentioned in the past because they're always relevant. Some are new, but I guess as I've highlighted here, a good first quarter, both on an economic and investment standpoint. In other words, we've had growth in Australia and generally globally in all the big influential economies, and also good returns in your portfolios, across the various asset classes, or most of the asset classes, is what that commentary means. So the rest of the first half of the newsletter is just on economic detail. Obviously, read that if you like in your own time. Any questions, you can shoot them through. And then briefly looking at home, at Australia, the economy is definitely, growth has slowed, as you can see, down to low sub 2% now. And a good year, just for a point of reference, is sort of something between 4 and 5. That'd be, boom times or breaching boom times. So definitely, economy's growing, but not at a massive clip. And importantly, the inflation number, which has been inflation's been a problem for about 3 years now, albeit it's falling. Still at sort of annual rates of 4%. And why that's important, for two reasons. One, it impacts interest rates, which if you're a saver, with inflation going up, is a good thing because you're earning more on your term deposits and your cash. If you're a borrower, not such a good thing. And also, again, it eats away at your cost of living or your purchasing power. So, if you've got $1 this year, it's only buying roughly 95 cents worth of goods next year with a 5% inflation rate. Real simple analogy, but so inflation is one of the main indicators that is relevant to a financial planning standpoint for those reasons. But yeah, good news is it's coming down, and it's a lot lower than it was a year or two ago, which is sort of the 6 to 8% band, leading to the question: what happens to interest rates in Australia? The view and the commentary is that probably, for the time being, they're going to stay where they are, which is great if you're a saver. And relative to, say, America and most other main sort of Western large economies, we're probably the central bank here, the Reserve Bank's probably going to be later or further down the track when they start cutting rates, much to the dismay of my clients with hefty mortgages. So house prices, again, very relevant for almost all of our clients. Pretty strong still, and Sydney being the most relevant area for us. The broad Sydney index, nearly 10% growth in the last 12 months. So once again, great if you have a house, not so great if you're trying to buy one, or your kids or grandkids or whatever. And I think this commentary is a little bit political, but it does raise a good point that one of the challenges is, while immigration is great for economic growth, um, in a way keeping wages down because there's more supply of labor, which means, other things being equal, cost of goods is more attractive and services are cheaper, all things we purchase every day. The offset to that, of course, is there's not enough houses to house these people or units or whatever. And this is a pretty interesting number that building approvals are at a 12-year low. So, these are not easy fixes. So I suppose the takeaway from this is, if you're in a house, you're in a good situation, or if you're saving and trying to get into something, make sure you've got a pretty solid plan in place and try to keep the emotion out of it. Easier said than done, but anyway, we can take that offline if anybody has specific questions. So a quick overview that covers the economic side of things. And if we look at the investment side, or what we call asset class returns, which is where the detail is in terms of the drivers of your particular account balance, whether it's super, pension, investments, whatever it is, shares. Again, the short term really is just commentary, and in a way, it's what I call noise, right? The lot of the short term numbers are fairly random, or not a lot. They all are. What counts is the long term. So we're generally hunting in the 10 to 20 year your bucket, if you will, or time frame. But for the sake of today's chat and commentary, in terms of short-term trends and what's been happening, you can look at the 3-month or the 1-year column here. And we're going to look at another table shortly, which presents it in a slightly different way as well, if this one doesn't work for you visually. But the key takeaway here, as I've highlighted in the commentary, again, pretty much a very good March quarter for shares, particularly global shares. So you can see here, second last column where my mouse is hovering. Let me just zoom in a bit. 14% for the global share index in the March quarter, 28% in the last 12 months. So really, well above long-term averages, which would be very high single digits or low double digits, depending on what time frame you choose. But if we looked at, say, 10-year, the average is 13%. So for global shares. So as you can see, more than double the 10-year average in the last 12 months to the end of March for global shares. Dominating that is the US share market, which makes up about 65% of that measure, the stocks in that measure. Aussie shares here at 5.5% for the quarter, still pretty, great 1-year return as well, 15%. So the only red spot really in the short term has been in bonds. As you can see, global bonds slightly negative, and the driver behind bonds, the number one influence on bond prices, is the outlook for interest rates. And so what's been happening recently, a bit like the Reserve Bank in Australia and their commentary about, they're not in a rush to start cutting rates. Because inflation is what they call sticky in many countries, in the West, again, Europe, US, etc. Because it's sticky, banks are sort of, or commentary from the central banks is that they're not in a rush to maybe start the easing cycle, and bonds react to that because effectively, a bond is just a future promise to pay, a bit like a term deposit. And a bond has a fixed interest rate. So if that bond has been issued at a lower rate, which the last few years when rates were low, bonds were issued at lower rates, maybe a 10-year bond at 2 or 3%. The market has to adjust those prices because they're not as attractive if there's a prospect or an outlook for bonds to be issued at higher rates, which is what's happening at the moment. So that's sort of a natural adjustment process, a little painful when it happens in your portfolios. But again, the point is we don't have all your money in one particular asset class. And for most of you, the majority of your money is invested in the growth area, so stocks and property of some form or another in very broad terms. So that's one way to, yeah. And so just to sum up here, as I mentioned with the bond prices were down, and the relationship again, just to revisit what I've been saying, is they go the opposite direction to interest rates. So if interest rates are going up, bond prices are falling. And again, I'm happy to have an offline chat one-on-one with anyone who might want to know more about that, how that works. But it all gets back to the inflation outlook, which links to the interest rate outlook, which impacts that particular part of your portfolio more than the rest, certainly in the short term. Let's have a look at another table, which you might look more familiar because we generally present this as part of your pack when we do investment strategy reviews. And I've just cherry-picked a couple of different data points here. So again, this is returns to the end of March across multiple timeframes. And again, where we're hunting and digging and investing is sort of out here, right? 10 years, 20 years, because it's the long term that matters. And so if we look at how the updated numbers are, the last 10 years, Aussie shares, again, this is a guide, not necessarily exactly what you've earned, but a good starting point. Compound return of 8.5%. And a reminder that includes dividends. So historically speaking, you're looking at about a 4 or 5% dividend yield in Australia. So roughly half that returns come from dividends, which when you back that out, doesn't make the capital growth look great. And I guess if you look at what's in our index, or, what you can invest in Australia, it's old world economy stocks, and they're doing okay. Banks, resources, industrials, etc. But they're not seeing the sort of exponential growth that technology is seeing, for example. And therefore, when you jump across to the global share returns, the last 10 years, almost 50% higher proportionally on average per year, the compound return versus what you've earned from Australian shares. And that's because there is a lot more diversity of sectors and opportunities in the global market. And again, the US is dominating that figure at sort of 60, 65% of the value of that measurement or index. We don't know the future, of course, so I'd love to say one's going to do better than the other. Again, the trick is, I think, to make sure that you've got appropriate diversification. In other words, money spread around the main asset classes. What this doesn't show you as well with Aussie shares is there is a tax benefit there, which is effectively risk-free. So that's a tick in the box, even if the absolute returns are a bit lower or significantly lower in this case. Depending on your tax structure and your age and stage, there is merit for maybe having more than you would otherwise in Australian shares versus global. And some of our clients like to see those dividends dripping through their account as well. So there's all those factors that play in. So again, as I've stressed before, these commentaries are broad and general, right? It's not specific to your situation. Always can take an offline chat with you if you need to, if we're not already covering it in review meetings or ad hoc meetings, etc. And as you can see here, those numbers for the 1 year for the shares pretty much mirror what we looked at on the other table. I guess the other thing to mention as well is for the first time in a while, you can actually get a decent return from in Australia from cash rates. Most of you probably, if you do have term deposits, would be earning well over 4%, maybe even low fives. So that's where we've been. What's equally important is, let me just have a little chug on my coffee before it gets too cold. What's equally important is we're looking at the building blocks here of the of your portfolios. So what's equally important over building blocks is the actual, what I would call the sum of the parts. How does this add up into actual returns, right? Into actual movements in your particular investment or account balance. And so a good way to look at that is the Vanguard funds, because they are a really broad, low cost, well diversified guide to what kind of returns you might be looking to earn. And with our strategies for most of our clients, we use this as a starting point. We either have clients in these type of funds or similar, and we aim to be earning returns as close as possible to this outcome, or even slightly better if we can. That's the idea with having an investment edge. So I digress, but the point of looking at this chart is just to get a feel again for the trend of what's been happening in a typical portfolio. And so this chart here, hopefully looking familiar, and it's just a simple, if I started with $10,000 in a Vanguard 70/30 fund, which is what the growth index fund is. So put that in plain English, that is a fund that has about 70% of its money in some form of growth assets. Australian shares, emerging market shares, global shares, listed property, etc. The balance of 30% in cash and bonds of some form. So the reason we pick 70/30 or the growth index fund is that's quite representative of, the main part of the bell curve, or the majority of our clients sort of sit in this area, and most people, non-clients as well, from what we've seen and the research we look at. You'd be at a 70/30 or a 60/40 or an 80/20. So it's just a good proxy, quick and easy way to look at what's been happening over time to the value of a typical portfolio. And so this is a 70/30, as I said, and a 5-year horizon. And as you can see, pretty much since October last year, the growth has been very strong. So your 12,000, call it 12,400, has grown to 14,290. So the trend is still pointing up, and I think that that shows you just how strong the growth has been. And roughly speaking, from 5 years ago, $10,000 invested is now worth, as I said, 14,000. So roughly a 40% increase over 5 years, or rough numbers, an 8% growth per year. The other thing is this excludes income as well. This is purely the value of the fund over that time. So you probably add another 2% to that. Bottom line is it's been a really good period for investing, and let's hope that continues. The more things go up, the more the risk is that they have a bit of a pullback, a correction. And so the key thing is, again, this is an individual thing depending on what we've built for you with your targets, your investment strategy, your risk profiling, etc., is to make sure that you are tracking to target. And if we need to make a change, then we make that change, and make sure we're not carrying too much risk, or on the flip side, that we're getting exposure to those assets that are going up in the right amount for your individual or specific situation. So yeah, in summary, things have been tracking well. Pretty strong period that we're in. If there's any concerns or questions at your level, don't hesitate to drop me an email. If we've seen you in the last 3 months, chances are the settings are where they need to be. If we're seeing you in the next month or two, there's probably no need to connect unless something really concerns. But outside of that, feel free to drop me an email if you need further customized advice. So that covers the investment stuff. Let's move on to a couple of interesting articles and how they might be able to help you. First one is let me find it here. So as many of you would know, the business subscribes to a couple of different services. One is Money Magazine, and it's a great, often a great source of ideas and input for what we're doing for our financial lives. Again, if anyone would like this, happy to get the team to email it to you. Just send an email through with a request for the hard copy or the scan. But this is talking about, and we hear it almost, you know, at least weekly on the news about price gouging and monopolistic power, and it's the Greens are threatening to nationalize everything and control prices, and there's again, politics aside, there's definitely stuff going on that we need to be aware of and take action individually to protect ourselves from paying the wrong price or paying too much. And this article has 5 categories that it mentions where you could possibly look at taking action around getting a better deal. So I've picked 3 mainly because these are the ones I think would be most relevant to all of us. Some people don't travel, some people don't have mortgages, so I've left those 2 out. Power bills. So, again, unless you're not opening your emails or reading your posts, this wouldn't be a surprise. But as I've highlighted here, between March 21 and September 23, 22% jump in electricity bills. So if you haven't already, here's 3 steps that you should try to make sure that you're getting the best deal you can in light of what's going on with energy prices. Find the plan you're on, phone the company you're with to start with, and see if they can do you a better deal. And if not, go to energy comparison websites. And the one recommended here is the Energy Made Easy website. So that's 3 simple things. Another thing I've mentioned in the past, and we've done a bit of a blurb on it in one of my previous workshops, is Bill Hero. And we've used it in our family, and it was good news, bad news. So this is a service where you send them your bill and they'll automatically come back to you and tell you, hey, there's a better deal out there, or no, you're actually getting a great rate. So if you Google Bill Hero, if you haven't already, give them a try. It's I think it's $50 for a year. I think they might even guarantee you a refund if they can't find a better deal. Bill Hero, give it a try. Highly recommend it. Very easy to use. So that would be another option, as well as the comparison websites. So the second one to look at is supermarkets. And again, Coles and Woolies have a market share. I don't know if you know this, it's on the previous page, 65%. So they are just absolute monsters in our country, as I've highlighted here, 65% market share. And then obviously you've got the other players, IGA, Costco, Aldi, etc. So, and hopefully you're already doing this, but we all get busy and lazy and shortcuts and so on and so forth. And the other thing that was interesting was the specials are often very confusing. So just because you think you're getting a deal may not be the case. In fact, 83% of respondents to this choice survey actually couldn't really figure it out whether or not it was a good deal. And again, Choice, who we are a big supporter of as well, and subscribe to their magazine and website. They've got lots of case studies of Coles and Woolies doing dodgy stuff to try to make you think you're getting a better deal. So the trick is to be aware of is if you do shop at one place, you're probably overpaying. If you have the time, then shop around really. And again, it's sort of stating the obvious, but it's about making an intentional, conscious effort to do that if you can. What we've found, as a family is sometimes we go to Aldi and we buy all our staples, all the dry goods, generic stuff, and then we still buy fresh food from Coles or Woolies, etc. But everyone's different. Number 3, health insurance. So the what I didn't know, and again, it shows I don't look closely enough at my insurance, our family insurance policy, but the again, great research by Choice here, just at the first paragraph, that a lot of the insurers have been, I guess, sneakily increasing hospital cover rates at much higher than the advertised averages. For example, again, scroll down to this paragraph here in green. Gold hospital premiums have gone up by 31%. So the takeaway for me and maybe some of you, if you do A, have private health cover and B, have the hospital add-on or extras, just check, what you're getting, what the increase has been, etc. Because we just default to gold because young kids, family, all that stuff. We've got the means to pay for private health, but maybe it's not the best option. So. Again, what can you do to check it's all about digital tools and comparison websites, besides the good old fashioned using your brain and reading to start with, reading your existing policy or ring your insurer and ask them how it's put together and what goes in it. So this one here, again, Choice have a pretty good tool. Let me just find that for you, show you what it looks like. So this is a screenshot of Choice's comparison website. And a lot of these other ones, apologies, let me zoom in a bit. A lot of these other ones are big advertisers, right? CanStar, I hear about all the time. Compare the Market, that's the ridiculous ad with the meerkats, which my kids when they were younger used to love. So, hey, it's great advertising, but is it the most effective comparison tool? According to Choice, the answer is no. They only look at 10 health insurers. So the takeaway from this is, be aware, be checking the fine details, particularly around extras and hospital cover in particular. And if you want to use the Choice engine, because according to Choice, and I don't believe they have an axe to grind, right? They're a public service, they're a not-for-profit. You can just see from this table that they've got the broadest range of insurers that you can compare. There's also a federal government website as well. I didn't put the link up, but again, if anyone needs that, let me know. But that is the URL if you want to use the Choice one. There may be a paywall, I'm not sure. Again, let me know if there is, and we can see what we can do. So that's the third action where you might want to review or take some further steps. As I've mentioned before, we generally do our this kind of work in January or February every year. That's sort of our routine as a family. School's restarting, we do our budgets. Health insurance usually comes up as one of the top expenses. I think we spend about $8,000 a year. So my point in that is it's good to build this into a routine, right? Whatever your routine or habits are, there's no right or wrong or particular time you do it. Some people do at the start of the year because it's a school year and families, depending on your age and stage, are getting organized. Other people do it after the financial year, maybe when they're doing their tax. The point is I'd like to see everybody making it turn it into a habit. So you're doing it at least once every year. Hopefully that's making sense. Last but not least is the cyber safety, cyber security comments or article. And this really freaked me out because like everybody, I use QR codes quite a bit and they really boomed and took off. Apparently they've been around for 30 years, according to this article, but they took off dramatically in use during lockdowns when we started getting let out of the cage and you go to the pub or the restaurant or whatever and you'd have to scan your QR code to register your location. So where this is falling down is scammers are basically creating fake QR codes and sticking them over the real ones, and it's directing you to a fake website that looks like what you think is the real website, whether it's MyGov or Centrelink or the tax office, and then that's where they're getting your information because you think you're logging in and you're typing in your email and your password, and hey presto, they've got you. And so that's the highlights here is exactly that. Legitimate organizations is what are being impersonated. It's big in the UK. It's been happening a lot more than Australia so far. And the banks here I haven't seen the warnings, but probably don't read every single email to slap on the wrist for me. But I saw this article and it certainly got my attention. And so as I said, classic example here, Consumer Protection Agency criminals making their own QR codes and sticking them over legitimate codes, like things like parking meters, or also emailing you, right? So again, it looks like it's an email from whatever your insurer or the bank, asking you to scan the QR code for updating something or accessing some information, and then that QR code directs you to the fake website, and you start typing your details in, thinking it's legit. So in Australia, and I thought this was very relevant because lots of you, those of you that are retired or receiving some form of government benefit would be dealing with Services Australia. They are seeing scam emails, as it says here, right? So if you see that, do not act, right? Do not click on the code, whatever you do. So yeah, and again, even one from Medicare as well. Ah, bummer. Okay, let me just reset that. You've always got to have one or two tech glitches when you do these presentations, don't you? Maybe that's an excuse to have another sip of my coffee. Okay, here we go. So the last bit I wanted to mention was what can you do? Where are we? And my web is, of course, going a bit slower because I am hosting a workshop. So what can you do? Yeah, and just to finish off on what my experience has been, usually I'm in a rush, I'm scanning something, I'm trying to get something done, and you just assume that it's the right thing. And also as I get older, I need glasses, and sometimes I don't have my glasses on when I'm, running around. So I sort of glance at this thing, click it. So I can see how easy it would be to get scanned. And I think it's only a matter of time before it starts happening more in Australia. So give me the feedback if you've heard all this and it's old hat. Welcome any feedback about anything, as always. But for me, this is like alarm bells ringing. So what can you do? First one is, if you're in a public place, make sure, if you can, that it hasn't been tampered, right? If it looks like it's been stuck over an existing one. And then when it does direct you to the website, as it says, just check that, it's actually what you're expecting. And there's plenty of articles and tips and checklists around on how to spot a scam website. But the key point here, again, because so many of you use these services, just remember that MyGov or the ATO won't ever send you an email or a text with a QR code. So if you see that, run for the hills. So that covers the cyber safety lecture today. I'm definitely going to be more aware of things and follow those guides now that I'm aware of it. So yeah, we've covered. Let me jump back to the agenda. I'm going to open it. I'm running a little over, so I apologize. I've got another 4 or 5 minutes if anybody would like to unmute and ask questions or put something in the chat box. But in summary, it's been a good quarter for markets. Anything concerns you, drop me an email. Hopefully you've got some ideas there and some action you can take on ways to save a bit of money, or at least give you the peace of mind that you're getting a good deal for whatever your health insurance, power bills, so on and so forth. Hopefully there's some good takeaways on just watching out when you do QR code scanning, if you do that. So over to the room. Anybody have any questions, concerns, feedback?
Yes, I do.
If you're not, okay, fire away.
Simon, this is about another, I think, possible scam. I recently got a call from somebody purporting to be from Services Australia. They had my mobile number and my email address, but I'm sure it was a scam. I'm wondering how you protect your mobile number and email.
Yeah, look, that's a great question. I'd have to engage that with a cyber expert and get some answers back to you, Angela, if that's okay.
Thanks, Simon.
I suppose it gets back to, yeah, and thanks for sharing that. It's, there's so many stories out there, and a lot of people, sometimes if they are scammed, they're almost ashamed to talk about it because they feel foolish and stupid, and it's part of life and it's nothing to be ashamed of, right? So really, thanks for mentioning that, and I'll see what I can dig up. I suppose the short answer would be, again, back to some of those tips that came out in the article about easier said than done, but when you're on a particular website, make sure it is the legit website before you're
Yeah.
typing emails and phone numbers in. But let me see what I can find. Thank you.
Thank you.
Thanks. Okay, well, maybe people haven't had enough coffee today. Maybe have a shot. Come on, let's go. We've got a couple of minutes. It's anything else for a Friday to keep me on my toes? Although I'd quite happily go to the pub and have a steak for lunch and a beer, but that's not quite yet. So I'm here to serve. Um, Otherwise, yeah, if you'd like any of the articles, just drop an email to the client service team. Any feedback, welcome. Any suggestions for future topics, we welcome that. I will just give things another minute or so, and this will go up on our website as well in a week or two. So if you've got any friends or family that want to see how we work and some of the things we do for our wonderful clients, by all means, let them know. Good way to sort of meet me without meeting me. So um, you can have a soft approach that way. So thanks for watching, everybody. Really appreciate you taking the time out in your day. I hope you got something of value from today, and we'll see you in the next quarter. So have a great day.